The credit markets are flashing a signal, one that could reshape everything, and no one's talking about it. Credit is the market's early warning system. It's where stress shows up before the headlines, before the stock charts, and before most investors even know something's wrong. That's where the whisper lives. Here's what it's saying. Households are feeling the strain. That might not sound catastrophic, but it's the highest in years and it's climbing. In plain language, more people are falling behind, even with unemployment still low. Corporations aren't doing much better. This year is on pace to log the highest number of corporate bankruptcies since 2010. Through July alone, over 440 companies have already filed. And in commercial real estate, the pain is worse. Delinquencies in commercial mortgage-backed securities just hit over 7%, with office properties stuck at around 11%, and multifamily loans starting to wobble. Here's the strange part. If you only looked at credit spreads, the extra yield investors demand to hold riskier corporate debt, you'd think everything was fine. No storms, no defaults worth worrying about. That's the divergence. On one side, the hard data says stress is building. On the other side, prices say nothing to see here. When it closes, it can happen fast, and credit markets can reprice long before stocks catch on. That's why the smart money is quietly positioning now, hedging, trimming exposure, shifting into safer debt, while the average portfolio stays all in. This is the whisper. It's not a screaming crisis. Credit markets don't need to predict the future perfectly. They only need to move first, and history says they usually do. So how does this play out? In past cycles, a gap like this between worsening fundamentals and tight spreads has often closed one of two ways. Either the fundamentals improve, validating the optimism in prices, or prices catch up to reality by moving sharply wider. The second path is the one that tends to hurt, because when spreads widen, borrowing costs jump. Debt-heavy firms scramble for cash. Weak links break first, and the ripple moves outward. We've seen early signs of that scramble already. Companies with weaker credit ratings have been issuing debt now, even if they don't need the money yet, just to lock in funding while it's still cheap. It's what CFOs do when they suspect a window won't stay open forever. Commercial real estate is another tell. Office delinquencies have been high since the pandemic, but now the weakness is spreading into other property types. Higher rates and tighter lending standards are starting to bite. If that trend continues, it's not just a property problem, it's a bank and investor problem too. The big investors betting on this whisper aren't necessarily shorting everything in sight. Many are simply adjusting risk. It's less about calling a crash and more about refusing to overpay for risk when the fundamentals don't match the price. For a regular investor, the lead time isn't long. Not instantly, but the lead time can be short. In late 2015, credit stress foreshadowed an equity correction. And in 2020, high-yield spreads blew out before the fastest market drop in history. This isn't a prediction that history will repeat exactly. It's a reminder that credit sees things first. When you ignore it, you give up one of the market's best early warning systems. There's also a psychological angle. Most investors are trained to watch price, not plumbing. They chase what's moving and ignore what's quiet. Credit is quiet until it isn't. By the time it's obvious, the easy positioning is gone. So here's the mindset shift. You don't need to trade like a hedge fund to use this information. You just need to respect it. You can review your holdings for companies that rely heavily on debt markets. You can avoid adding exposure to sectors that are showing funding strain. Think of it like weather. If the forecast says storms are building, you don't cancel your life, you carry an umbrella. In investing, that means hedging the parts of your portfolio that would take the hardest hit if credit conditions change. Right now, the whisper is telling a story most people aren't hearing. Debt burdens are rising. Defaults are ticking higher. And yet the market is acting as if none of it matters. That disconnect is where risk hides. If you wait for the headlines, you'll be late. If you learn to hear the whisper, you can position ahead of the crowd, avoid the worst of the storm, and maybe even find opportunity in the shift. In practice, credit spreads are like the risk thermometer for the economy. When investors demand only a small premium over safe treasuries to lend to risky companies, it signals complacency. It's like insuring a house in a wildfire zone for the same premium as one on the coast. It doesn't make sense unless you believe the flames are under control or won't arrive at all. Another layer to watch is how quickly markets can move when the mood shifts. A single-week jobs report, an unexpected rate moved by the Federal Reserve, or a high-profile corporate default can flip sentiment in hours. This is why professionals act before they're forced to. History offers plenty of examples. In the summer of 2011, European sovereign debt concerns were brewing, but high-yield spreads stayed calm until late July. In 2018, credit weakness appeared in leveraged loans before stocks corrected that December. The patterns aren't identical, but the sequence rhymes. One overlooked angle is how credit market stress filters into everyday life. Companies facing higher borrowing costs may delay projects, freeze hiring, or cut back on marketing. Banks could tighten lending standards, making it harder for small businesses and consumers to get credit. These ripple effects can slow the broader economy even without an official recession call. The smart money's current playbook isn't about predicting exact dates. That could mean pairing safe bonds with selective risk in sectors that still show strong fundamentals, or using derivatives to hedge without dumping core holdings. For individual investors, this approach translates into measured diversification. It's the same principle pilots use when they correct course gradually rather than yanking the controls. What makes this moment so important is the blend of signals. It's not just one metric flashing red. It's household debt rising alongside delinquency rates. It's commercial property stress broadening. Each by itself is a warning light. Together, they form a pattern that experienced investors can't ignore. Why does this matter? Because when credit reprices, stocks often follow. This is also why big money rarely announces these moves. By the time the average investor notices, the easy adjustments are already made and liquidity in the riskiest corners has thinned. In the months ahead, watch for narrative shifts in financial media. Today, the tone is still optimistic, emphasizing soft landings and resilient consumers. That's often the final stage before prices move. The beauty of learning to hear the whisper is that it applies in every cycle. That's why some of the best investors in history, from distressed debt specialists to macro hedge funds, spend more time on credit conditions than on stock charts. The takeaway isn't to panic, it's to listen. That gap is opportunity for some and danger for others. If you want to monitor this yourself, focus on 3 dials. First, watch high-yield spreads. They start widening meaningfully. It's a sign the market is waking up. Second, follow commercial mortgage delinquency reports, especially for multifamily and office. Third, track the pace of corporate bankruptcies. You don't need to know every name, just watch the totals. If 2 of these 3 worsen at the same time while spreads are still tight, the whisper is turning into a shout. Subscribe now for more signals that cut through the noise and keep you ahead of the curve.